QuickBooks Online 2025 Inventory Tracking Options. Get ready and some coffee because we're learning how to save time with QuickBooks Online 2025. Here we are in our QuickBooks Online Get Great Guitars 2025 project file we set up in a prior presentation, continuing on laying down the foundation, similar to putting in the infrastructure of a city on which we can start building the building tools, in our case being the double entry accounting system, the transactions that we enter with the use of forms located under the plus or new button, broken out by cycle, which will then create the end result, that being the financial statements, balance sheet, income statement, and related reports. Now that we have our QuickBooks file set up, we took a quick look at the settings under the cog, and now we're going to be continuing on entering those beginning balances that we are imagining were from a prior accounting system, as we do so looking at one of the major foundational lists, that being the chart of accounts. So here's what we're imagining are the balances from the prior accounting system that we're going to be putting in our system, and then run the current data as we do data input for the current year, which in our case is going to be 2025. We're going to imagine these being the numbers as of 12/31/2024. As we enter these, we discussed in the past that we're going to be doing them one at a time instead of one giant journal entry entering all the transactions, because that will allow us to look at the specific needs for each account, which includes the subledgers. And we're going to start with the most difficult one, that being the inventory, noting that if you don't have inventory, you're not going to have to deal with that inventory situation. And even if you do have inventory, then you might not be tracking the inventory on a unit basis within QuickBooks, but rather tracking it outside of the system. So last time, we took a look at entering service items, which are going to lead into the entering of the inventory items, because they're going to be in the same foundational item within the QuickBooks file, although the service items are easier to input and they don't have an inventory component. So next time, we're actually going to enter the inventory items, but before we do that, we really want to think about what it means to have inventory and how you would deal with inventory. This is going to be really important because if you're a bookkeeper, what you want to do is think about what kind of clients do I want to be taking on? Do I want to be taking on clients where I specialize in a particular thing that's a little bit more difficult, but which I can charge more for? Or do I want to try to take on clients that I can automate as easily as possible, in which case I'm going to focus in on those industries that are most easy to do that with. Inventory is going to be one of those major factors you want to take into consideration then. In other words, if you want to try to do everything with the bank feeds, keep everything on a cash-based system, then inventory is going to throw a wrench into that system. It's going to be more difficult. Now, possibly that means that you might trim out and say, I'm not going to be dealing with certain businesses that have inventory needs. Or you could say, well, it depends how the inventory is being tracked. Are they tracking the inventory in the system, or are they tracking the inventory outside of the system? And how is that going to affect my automation of the system with the help and use of possibly the bank feeds, for example? So those are the questions that we want to basically address at this point in time. All right, so the first question is, do you have inventory? What kind of industry are you in? Are you in an industry that deals with inventory? If they're in an inventory that deals with inventory, an industry that deals with inventory, the next question is, well, are we dealing with an industry where you create or make your own inventory, which would be like a manufacturing type of system where you're going to have to deal with more complex inventory systems because you're going to have to track the raw material, the work in process, and the finished goods? Or are you dealing with a type of inventory system where you're basically just buying inventory, marking it up, and then selling it, basically acting as kind of like the middle person within the inventory line item? If they're actually building or making the inventory, then for small businesses, it's likely that it's going to be kind of a job cost system, a custom kind of project type of system. Larger businesses could be in more of a processing system, in which case you would have a process cost type of system. Those are all specialized kind of things that have their own special needs in them. We have other courses and sections specifically designed to job cost systems, inventory or job cost systems. You want to take a look at that. If they're buying inventory and then marking it up, then the question is, well, do we want to be putting all of the inventory tracking in units into the QuickBooks system, or possibly in many cases it would be more streamlined to not put it in QuickBooks, but rather to be tracking the inventory in whatever other kind of system, such as another website or such as Excel. For example, if you have an online store like an Amazon or a Shopify store, then many bookkeepers that specialize and accountants that specialize in tracking that information, and business owners that deal with that, right, would advise that no, we don't want to pull in all the information oftentimes from those systems into QuickBooks. Why? Because number one, it's redundant. You already have it on the other website. It leads to the possibility of errors because now you're running two parallel systems that possibly you don't need to do. And three, you're overloading your QuickBooks system with a lot of information that you might not need to do it, which could slow things down and cause you to upgrade for QuickBooks and so on and so forth. And four, you're dealing with tracking inventory within QuickBooks, which is kind of a difficult thing to do. It's a lot more complicated when you don't really need to, if it's already being tracked in terms of units outside of the system. So we have other courses and sections that specialize on like Shopify stores and Amazon, because there are different kind of ways that you can connect our system to those kind of online websites. But the general idea would be that the website itself might be tracking the units of inventory. And that means that in our QuickBooks system, within QuickBooks, we can kind of be more in a cash-based system for the cash flow, possibly relying on more on the bank feeds, which would be great to automate things. And then we have to do a periodic adjustment, a periodic inventory system based on the physical count that we're getting from our Shopify store. So, or whatever it is that on that side, right? We can imagine a similar kind of scenario on anything that we sell. If we sell widgets by hand, and we just sell them at a store, or we're selling whatever we're selling, units, then the question is, do I want to add those units into the QuickBooks system, not in terms of just dollar amount when I purchase them, but also the unit cost or the units of them, and track them within QuickBooks? Or do I just want to use a good old Excel spreadsheet over here and track the units and use just a physical count at the end of the day to see how many I sold, and then do a periodic adjustment into my QuickBooks system? So those are some of the complications. Now, one other thing that throws a wrench into the inventory is that you're going to have a flow assumption typically, which is going to be a first in, first out, or weighted average usually that you have to deal with. And that is the result of the inventory when we purchase it changing in dollar amount. So I can't just say, well, if I have 10 units of inventory that they all cost the same thing per se, because maybe when I bought them before they were cheaper and now they're more expensive. So when I sell the inventory, the question is, am I selling the cheap one or the more expensive one? We're going to use a flow assumption instead of trying to tag each unit of inventory. That's typically what we're going to have to deal with in that case. So that kind of complicates things a little bit. And the other thing that's going to complicate the system will be taxes, because oftentimes with inventory in the United States, we have a federal income tax system, but the states might put in a consumption tax, such as a sales tax is what we call it here. And that's gonna complicate the transaction that we put in place as well for the sales items. So those are the things to kind of keep in mind. So let's go back on over to QuickBooks here. And just remember that if we're going to set up our inventory items, it'll be similar to the service items. So if I go into the sales on the left-hand side and we go into the products and services, then we added these service items last time. If we add an inventory item, I won't actually add it this time, but let's just look at what is in play here. If I add an inventory item, you'll see that we have the name. We've got the inventory item SKU, which would be an identification number if we're using that. The category, if we have multiple categories. We have the initial quantity on hand. Note that that's not there if we're dealing with service items because we don't have any quantities. This is the thing that's going to allow us to track by units of inventory. Now note that the thing that we're building, the financial statements, are not tracking by units. They're tracking by currency, by dollars. So that means that I have to have a subledger account that's going to give me the units and then convert that to the dollar amount in some way using a flow assumption, first in, first out, last in, first out, and so on. So we'll deal with, and then we have the sales description. This is what's going to be showing up on the sales forms when I use a sales receipt, if it's at a cash register, or when I use the invoice, if I sell it with an invoice. And then we also have the purchasing side of things, meaning I'm going to have to buy the inventory, and that's going to be on a bill form or expense form, and possibly also using a purchase order, and then I'll have the cost. So you can see it's a lot more going on with the inventory item. So that means if I hit the plus button, the forms that will be involved here when we buy the inventory, we're buying it from a vendor, either an expense form, a check form, and we might have a request first, a purchase order. And then when we sell the inventory, we're going to sell it with an invoice form or a sales order. Now you might have a very simplified system where you're trying to wait till something clears the bank and you record revenue with bank feeds, but that's going to muddy up the waters a little bit for tracking inventory and for recording sales tax. Let's take a look at these systems by thinking about a flow chart. Now this is the desktop flow chart. I'm using it to demonstrate just the flow of the forms, which is the same for basically any accounting system, but the names of the forms will basically be the same for QuickBooks Online. So we're using the QuickBooks desktop homepage flowchart in order to just analyze the flow of forms, but we're doing that for the purpose of QuickBooks Online. Hopefully that doesn't annoy people too badly. All right, so that means when we get the inventory, what's going to happen? We're going to have both sides. It's not just in one cycle. We have two cycles affected because we have to buy the inventory and then we have to sell the inventory. Now, so what would be the easiest thing to do with inventory? It would be to try to stay in a cash-based system. And if you have a very simple inventory system, you might be able to do that. So for example, if you're a small business and you make, necklaces for somebody or something like that, or you make something and you buy the stuff to make it, and the turnaround time is pretty small between when you buy the stuff and when you actually sell the stuff. Then what would be the easiest thing to do when I buy the stuff, which with a check form or expense form or a bill, or possibly, of course, in QuickBooks, maybe with the use of the bank feeds, meaning it comes through the bank feeds as you bought something from the supply shop, then you might just record it as cost of goods sold at the point in time that you bought it. Now note that from an accrual standpoint, that's not quite right, because how could you have a cost of goods sold and expense that is usually defined as something that was consumed in order to generate the revenue in the same period before you recorded the revenue, right? Because now you're recording the cost of goods sold before you got the revenue. But we think that we're going to sell whatever we made, the necklace or whatever, pretty soon. And therefore the timing should be pretty close, possibly close enough for us to do the easy thing, be on a cash-based system. So then when I sell the necklace with an invoice form, a sales receipt, or possibly I wait till the transaction clears the bank and record it with a bank feed that's an increase to the checking account, then I can just record that to revenue. And that would be the easiest thing to do. The timing's a little off, but I'm just on a cash-based system. I'm buying stuff for the creation of inventory, but I'm not holding on to a lot of inventory. Therefore, I'm not putting it on the books as an asset, but simply being on a cash-based system, expensing the stuff when I buy it as cost of goods sold, and then recording the sales side just as I would with a service item. Easy, no problem. But if we get a larger units of inventory, we're holding on to the inventory, or there's a long time period between when I buy the stuff and when I sell it, like in a job cost system, in which case if I'm building a house, Well, now I've got this long lag period. I'm buying all this stuff for a long period of time, and I'm not going to actually generate the revenue until a later point. That's when you need a job cost system, which is a specialty kind of area in and of itself, which might have different revenue recognition principles like percentage of completion and so on. We have other courses again on that if you want to dive into that in more detail. But that's kind of like a specialty area that you can specialize within. So then, well, what if I'm buying inventory, marking it up, and then selling it? So I'm buying it, I'm marking it. What would be the easiest thing to do from a logistical standpoint within QuickBooks? Well, the easiest thing to do would be, well, I'm not going to add it to the QuickBooks as inventory items, but rather track the inventory in units outside of QuickBooks, and then I will do a periodic adjustment within QuickBooks to adjust the dollar amount using, a cost of goods sold type calculation. So in that case, that would be like the Shopify store or the Amazon, or if you just sell units of stuff, you're out on the street selling whatever units of stuff, then what you're going to do is say, what did I start the day with, right? How many units did I have to start it? Would be our good old formula for cost of goods sold would be beginning units. Let's say we had 10 units, and then we purchased during the day. Let's say we purchased 5 more units. So now we have available for sale. How many units do we have available for sale in the day? We've got 15 units, and then we have the ending units. How do I know how much I have at the end of the day? Because I count them, right? And I have 7 units, and so we have cost of goods sold. How many units did we sell? 15 minus 7, that would be 8 units that we have sold. So then I could basically say, based on that calculation, I'm gonna convert that to dollar amounts, right? Which is a little bit more complicated because I have to use a flow assumption possibly, meaning how much did those units cost, right? Let's say they cost, $10 each. Then we can put this into our QuickBooks system with basically just a journal entry, reducing the inventory by dollars of $80 and recording the cost of goods sold of $80. Now, again, it's a little bit more messy than that because maybe the units don't all cost $10 because they used to cost $8 until inflation happened because of the Biden administration. No, they're trying to blame the current administration. Anyway, it's inflation happens. That's what normally happens. You get a little bit of inflation, at least, or a lot of inflation oftentimes. Sometimes there's deflation, but usually, and that means the price is going to differ, and then you have to say, well, which of the units did we sell? But that's going to be the general process that you can do this kind of calculation and then simply do a periodic adjustment. Now, it also gets a little bit more complex, of course, when you have multiple different units of inventory and you're trying to track all those different units of inventory. And the more complex that system gets, the more complex your needs are with inventory tracking, which QuickBooks can provide to some degree with a basic QuickBooks. But as you get more complex, like a large store that sells many different things, you're going to need more possibly complex inventory needs, which that's when you might have to level up to a more expensive QuickBooks, or to like QuickBooks Enterprise, which is a desktop version that has possibly more complex inventory needs, or even beyond that to more customized types of inventory needs. So that's the next easiest thing to do, because what would you do within QuickBooks when you do that? When you buy the inventory with a check form, expense form, or a bill form, you can just record it to inventory. So you're still doing the accrual thing, but I'm not adding the inventory items. I'm not tracking the units of inventory in that way. And then when I sell the inventory with an invoice, sales receipt, or deposit form, then instead of entering it as an inventory item, I would enter it as a service item or a non-inventory item, meaning I'm not going to be tracking the inventory within the system. So that means that it would record it just like a service item. All I would have to do is record the sales side of the transaction, and then I would have to add another transaction to record the cost of goods sold. based on my calculation like this on a cost of goods sold calculation, which I might do on a nightly basis, on a weekly basis, on a monthly basis, on a quarterly basis, or on a yearly basis, because I'm going to need it at the least for income tax preparation at the end of the year if you're in the United States, because even if you're a sole proprietorship, the tax return only has like the income statement. The Schedule C is in essence the income statement, but it also has a cost of goods sold calculation, which is kind of like this calculation, which means it's pulling in the balance sheet items of inventory, beginning and ending inventory. So it wants those numbers. So you're going to need those numbers at least on a yearly basis. All right. And then what's the most logistically complex way to do it, but the best way from a logistical standpoint to track the inventory? Because note that this calculation over here, like, doesn't really account for things like shrinkage and theft, which you got to account for if you're doing business in California, right? I mean, so you could do some, right? You could do some like some analysis to kind of estimate those things based on you can tie out your unit sales to your revenue to figure out how much you think was theft and so on. But it would be better if you're tracking the inventory within the system by entering the inventory items, and then the system will be tracking inventory, and then you still do a physical count. And so now you can track what the inventory should be if there wasn't theft or shrinkage to what it is actually based on a physical count to determine exactly what the theft and shrinkage is, right? So in that case, what would that look like? That means when you buy the inventory with a bill or check form or an expense form, you're going to not only put the dollar amount on the book, but you're going to enter the inventory items, which will create a subledger tracking the inventory. And then when you sell the inventory with an invoice or sales receipt, notice QuickBooks can't use a deposit to sell the inventory if you're tracking the inventory on a perpetual system, units of inventory along with dollar amount in QuickBooks, because the deposit form isn't designed to track the units of inventory. You would have to use the sales receipts and the invoice form. So in that case, it would record not only the sales item, but it would also record the decrease in inventory in dollar amount and units and the related cost of goods sold at the point in time that just sell it. So that would be great. And it's easy to do once you have it set up. It's easy to enter the invoice and the sales receipts. So, but it takes a lot more time and effort to set up the items properly and make sure that you're tracking the inventory and tying it out to the physical account and so on and so forth. So those are the different methods that you can use within QuickBooks. So if someone says they have inventory, that doesn't really stop the discussion. You want to keep going from there and say, okay, how exactly are we going to deal with the inventory, right? Can we be on a cash-based system because you have some kind of not much inventory? Should we be tracking inventory within QuickBooks or outside of QuickBooks? If we track it in QuickBooks on a perpetual system, is QuickBooks good enough to track that the level of inventory needs that you have, or do we have to level up to some other inventory system in order to do that tracking system? And whatever system we have, how are we going to calculate the sales tax? If you create invoices and sales receipts, you can track the sales tax as you generate those forms. But if you're recording revenue with a deposit form or something like that, then you're going to have to also manually figure out how you're going to calculate sales tax to make sure that you're including that in the sales price, and that you can then pay for the protection money that they give you for the sales tax. They shake you down. The government shakes you down just like a mobster. And then if you're in California, they still let the criminals come in. At least the mobsters stop the other mobsters from coming in and just walking out with things. You know, the government shakes you down and they still let the rival mobsters rob you. And then they laugh at you. Anyways, whatever, dude. All right, so that's gonna be the general item. So next time we'll enter the products as though we're tracking on a perpetual system because that's the most complex system. And then you can trim back if you have a little bit less complex system.